Did you know that putting all your eggs in one basket is a terrible idea unless you're in an egg-carrying competition? Now imagine you're a farmer, and you decide to plant only apples. Sure, you love apples, but what if there's a sudden apple disease, or a swarm of apple-loving insects? You're going to be left with nothing but a field of disappointment and a lot of applesauce. But, let's say you're a different kind of farmer. You plant apples, sure, but you also plant oranges, grapes, and a few strawberries for good measure. If the apple apocalypse comes, you're still going to have your oranges, grapes, and strawberries to fall back on. That, my friends, is the essence of diversification. It's not about making a fortune overnight, it's about spreading your risks and increasing your chances of consistent returns over time. Just like the farmer, you don't want to risk your financial future on one investment. So, what's the solution? Diversification. Imagine you're on a game show, and the host offers you a choice between one big prize or several smaller prizes. Which would you choose? In the world of investing, this is akin to the choice between putting all your eggs in one basket or spreading them out. The former might sound appealing. Who wouldn't want to strike it rich with a single savvy investment? But the latter, known as diversification, holds the power to increase your chances of overall success, while mitigating risk. Let's stick with our game show analogy. Suppose the one big prize is a shiny new car. It's gorgeous, fast, and you've always dreamt of owning it. But what if there's a catch? What if it's a lemon, and it breaks down a week after you drive it off the lot? That's the risk you take when you put all your investment in one place. On the other hand, the host offers you an array of smaller prizes. There's a high-quality coffee machine, a smart TV, a designer watch, a few shares of an up-and-coming tech company, and even a modest cash prize. Each of these prizes carries its own potential for joy and utility. But more importantly, they spread the risk. If one prize turns out to be less than expected, it won't spoil the whole lot. Diversification in investing works much the same way. It's about spreading your investments across a variety of assets, such as stocks, bonds, real estate, and even commodities. The goal here is not to put all your hope into one investment skyrocketing, but to build a portfolio that can withstand the ebbs and flows of the market. Some investments may go down, others may go up, but overall, your portfolio is designed to weather the storm and come out on top. So in the game show of investing, it's often smarter to choose the variety prize pack. That's diversification. It's not about winning big with a single bet, but about playing a strategic game that increases your chances of overall success. In the end, you might find that the combined value of those smaller prizes far outweighs the allure of the big one. Now, imagine you're at a dance party. Would you dance only to one song all night long? Picture this, you're at a party, and the DJ keeps playing the same tune on repeat. Sure, it might be your favorite song, but wouldn't you eventually get bored? Would you want to keep dancing to just one rhythm? The same principle applies to diversification in your investment portfolio. You see, if you were at a dance party, you'd want variety, right? A bit of pop, a touch of soul, some funky electronica, and maybe even a slow ballad or two. Each of these dance styles represents a different type of investment. Think of stocks as your upbeat pop music. They're exciting, they get your heart pumping, and they can offer high returns. But, just like pop music can become tiring after a while, an all-stock portfolio can be volatile. Next on the playlist we have bonds. Bonds are like soul music, steady, reliable, and comforting. They don't offer as high returns as stocks, but they provide a cushion of stability. Having bonds in your portfolio is like having that soul song that soothes you when the pop music gets too loud. Then we have real estate, the electronica of our dance party. It's a different beat altogether, isn't it? Investing in real estate can provide income through rent and potential appreciation in property value. It's another rhythm to add to your dance. And let's not forget other investment avenues like commodities or mutual funds, each a unique dance style adding to the richness of your party. So, when you're at this investment party, you don't want to be stuck dancing to just one song, do you? You want to mix it up, experience the different beats, and enjoy the party in its entirety. That's what diversification does for your portfolio. It allows you to spread your investments across different asset classes, reducing risk and potentially increasing returns. So don't be a one-song dancer in the investing party, mix it up with diversification. Just like a good DJ keeps the dance floor alive with a mix of different tunes, you should keep your portfolio lively and diverse. Ever watched a football game where the team uses only one strategy? Well, that's a surefire way to lose, right? Just like in football, when it comes to investing, relying on one strategy or one type of investment is a risky game. Let's explore this idea using our football game metaphor. Imagine you're the coach of a football team. You have your star quarterback, your fleet-footed wide receiver, and your rock-solid defense. Yet, if you continually rely on your quarterback to score touchdowns, eventually the other team will catch on, right? They'll start to anticipate your moves, and before you know it, your one-trick pony is no longer scoring. Now let's swap that football for a financial portfolio. If you put all your money into one stock or one sector, sure, you might score some initial gains, but what happens when the market changes? When that one sector takes a downturn, suddenly your portfolio is on the back foot, scrambling for a recovery. This is where diversification comes in. It's the equivalent of having a playbook full of different strategies. You've got your running game, your passing game, your special teams, all working together to keep the opposition guessing and to keep those points coming in. Similarly, with a diversified portfolio, you've got a mix of different investments. You might have some stocks, some bonds, maybe even some real estate or commodities. Each of these investments performs differently under varying market conditions. When one is down, another might be up. This is what we call non-correlation, and it's a key principle of diversification. It means that not all your eggs are in one basket, or in our football game, not all your plays are reliant on your quarterback. So, how do you go about diversifying your portfolio? Well, it's all about balance. You want a mix of investments that align with your financial goals and risk tolerance. Some people might want a 50-50 split between stocks and bonds, others might go for a 70-30 split. There's no one-size-fits-all approach. It's about what works for you and your financial game plan. But remember, diversification isn't just about dividing your investments between stocks and bonds. It's also about spreading your investments across different industries, companies, and even countries. This way, if one area experiences a slump, your entire portfolio doesn't have to take a hit. Just like a winning football team, a well-diversified portfolio uses a mix of strategies to score financial success. It's about being prepared for whatever the market or the opposition throws at you. So, whether you're a seasoned investor or just getting started, remember the importance of diversification. It might just be the game-winning strategy you need. So, where does this diversification journey lead us? Well, picture this. You're on a ship, sailing towards the horizon. The sea is your investment portfolio, and diversification is your compass. It's the tool that guides you, ensuring you don't drift helplessly on a volatile ocean of financial uncertainty. Now let's take a moment to reflect on our journey so far. We've explored the dilemma of diversification, discovered its power, danced through its dynamics, and witnessed it in action. It's been a thrilling ride, hasn't it? But where does it all lead? What's the destination on this financial voyage? You might think the answer is wealth, but that's just one stop along the way. The ultimate destination, my friends, is financial security. Diversification doesn't promise you a golden ticket to instant wealth. It's not about buying that winning lottery ticket or making that one lucky bet. Instead, it's about spreading your investments across different asset classes, industries, and geographical areas. It's about reducing the risk and smoothing out the ups and downs of the market. But why do we do this? What's the point of all this diversification? The answer is simple: to protect your hard-earned money from the unexpected. Market crashes, industry downturns, unexpected geopolitical events. The financial world is full of surprises, and not all of them are pleasant. Diversification equips you with a financial shield, guarding your wealth against these unpredictable events. So diversification is about more than just spreading your eggs across different baskets. It's about ensuring that no matter what happens, you'll always have a steady income stream. It's about securing your financial future, your dreams, and your peace of mind. In short, diversification is your ticket to a smoother, steadier, and more predictable financial journey. It's your financial lifeboat, ready to keep you afloat even in the stormiest of seas. Remember, diversification is not about making quick gains. It's about setting a steady course for long-term financial success. So set your sails, adjust your compass, and let's continue this journey together.